awesome YouTube video. Now in this video we're going to get into supply and demand. Now I know a lot of people already are familiar with the concepts of supply and demand. Let me take off this mask for you guys just so that I'm a little bit more presentable. So guys, a lot of people are familiar with the whole concept of supply and demand, but then again there are people that are not that don't really understand the fundamental reasons of why supply makes prices go down lower, why demand increases the value of an asset. And that's what we're going to speak about today, guys. Remember, in these videos, guys, that I make for you, I don't want to go over stuff that's going to benefit you for one specific trade or one specific whatever it is. I want to give you information that is going to change the way you understand, your general understanding of the markets. That's what I want to enhance, or that's the information that I want to give you. So guys, going straight into it, supply and demand, we're going to get into this. So supply basically equals sellers. So when we see supply in a market, so we'll just do this. We'll denote our x-axis. Let's just use a different marker. So we'll denote our x-axis, we'll denote our y-axis, and obviously when supply increases, now let's just speak about this. Let's just say we have one brick of, let's just call this a bar of gold. We'll say that this is a bar of gold. We're going to make this example. Now what happens when the supply, or when there is an excess of supply? Obviously, when there's more supply of a particular thing, then the prices of that thing drop because there's more of that particular asset within circulation. Now, we'll go over to the other end. We said that demand equals buyers. So what happens to an asset when there's more demand? When there's more demand for a particular asset, the prices of that asset increase. When a lot of people want to buy this brick of gold, let's just say that we have only one brick of gold, and there's, let's just say, one buyer for this brick of gold. Now when the demand increases, when the buyers, the amount of buyers that want a particular asset increase, then the value of that asset, the price of that asset increases as well. Now let's just say that there are two people that are willing to buy this brick of gold. Now the demand has increased for this particular asset. This particular asset can go off or can auction at a higher price. Now this foundation is essentially more important than any other foundation, I guess, when it comes to trading, because supply and demand are the two factors that move any asset class. Whether you're trading forex, whether you're trading commodities, whether you're trading metals, whether you're trading indices, whether you're trading futures, bonds, whatever it is, supply and demand is what moves that particular market. Now let's go into this, guys. So we have our first point here, that when supply increases, prices move down. So we're going to denote that by just giving an example of a chart. Let's say this is the chart of gold, and we'll just use the red marker, or let me pick it up. We'll use the red marker to kind of denote the prices on gold. So we'll just say that gold, for whatever reason, started up top here. We have whatever consolidation. Obviously, we know that when we see consolidations, like we discussed in our previous video, this indicates a fair value area where both buyers and sellers are happy to transact. This denotes, in terms of supply and demand, what a consolidation denotes is that both supply and demand are equally matched, or both buyers, remember we said that supply is denoted by sellers, demand is denoted by buyers, both buyers and sellers are equally matched. So do you see how all of these concepts, all of these ideas tie into one basic thing? And a lot of people go straight into trading without really understanding why. Guys, the why is the most important thing. Yes, we know markets move up and down, but why? So anyway, with gold, what we're going to say here, let's just have this market actually break to the downside. We'll say that we broke to the downside, and when we came to the downside, we consolidated a bit more, we broke back to the upside. So how we can denote this, or what information can we derive from this? When prices started off, somewhere, somehow, the supply came in, the sellers came in. What happens to the prices of an asset? Remember, on our left hand side, guys, like we spoke about in the previous video, we have prices. double zeros, 50s, double zeros, 50s, double zeros, 50s. On our y-axis, guys, we have price. Now, obviously, like we said, when supply comes into a particular market, what happens with the prices? Prices move down. So that's it, guys. It's literally that simple. When supply enters the market, prices move down. Prices move down until the demand for that particular asset increases, or until the balance between the supply and the demand changes. Now, let's throw a spanner in the works, guys. We spoke about when supply comes into the market, prices go up. When demand comes into the market, prices go up. Now, what happens? Let's just say demand remains equal. Now, we can also denote that when supply decreases, when there are less, or when there's less supply of a particular asset, less sellers willing to sell a particular asset, then prices move up. So in this case, let's just say here, for whatever reason, supply came in, pushed prices down to the bottom. Because prices left this bottom area, this does not mean that demand came in. It can mean one of two things. It can either mean, yes, the demand obviously maybe increased, or it can mean that the supply of this asset is decreasing. When supply decreases, or let's use the red marker, when supply decreases, then prices move up. And obviously when demand decreases, then prices move down. So we want to understand, the point of us going into all of this is to understand the fundamental natures of the market. Now also, we're not just going to go over the general idea of what supply and demand do, but I'm going to explain to you guys how you can be using supply and demand to, first of all, find areas of value, second of all, determine entry points, and third of all, determine exit points. Now, in general, what we've been taught as retail traders is obviously support and resistance. So support and resistance are obviously foundations of supply and demand. This would be our resistance, this would be our support. Now, this would be resistance, this would be support, this would be our supply, this would be our demand. Now, generally, what we want to do is we want to obviously involve ourselves in these areas of supply and demand, and we want to look to exit the market in these areas of supply and demand. Now, going into an actual strategy or something that you can implement within your own trading of how you can use supply and demand to first of all understand what's happening within the market. Now before we even go into this, guys, let's build a foundation. Now, how can we know whether there's more supply or there's more demand within a market? Obviously, we look at order flow. Order flow is going to tell us the amount of supply or the amount of demand that is within a particular market. How do we know what the order flow is or which direction the order flow is? Guys, the general basics that we learned, identifying trends. The moment we see a market that is trending to the upside, what can we denote from this? Remember, we said that whenever demand increases, prices move up. What is happening at this support area over here, or this demand area? Prices are increasing. What is happening at this demand area? Prices are increasing. What's happening at this demand area? Prices are increasing. Which direction is the order flow? So obvious, guys. We can obviously see that prices are increasing and there is more demand for this asset as prices are increasing. So we can already, from the trend, obviously basic information, identifying our trend, determining the direction of this market first. Now we understand that order flow is to the upside. There is an excess of demand. There are more buyers willing to participate within this market. Obviously, for however long. We know no market trends forever. So at the current time, there's obviously more demand for this particular asset. Now, obviously, where are we looking to enter the market? If we are looking at the order flow, we're looking at the direction the market is trending in. We want to enter the market when demand is entering the market. How do we know? Where do we enter? At our support areas. Where do we exit? At our resistance areas. Let's just use the other marker for this. At our resistance areas. That's where we should be looking to manage our positions. Now obviously there's other ways of entering and exiting the market. Obviously we know that prices are obviously fractal in nature, and maybe there's other supply areas within these areas where we could also target, obviously based off previous price action or other market data that we do see. But in general, guys, supply and demand, now this is the meat. This is what I actually want you guys to get from watching this video. Supply and demand give us an idea of where the market could go. So supply and demand tell us, for example, we're in an uptrend. Supply and demand would give us the information that prices can move from these areas over here all the way to these areas over there. So prices, any market always moves from an area of demand to an area of excess supply. Obviously, if the inverse was true, if we were in a downtrending market, then the markets would move from an area of supply to an area of excess demand before we see any type of reaction. That's just what it is. So guys, going into the actual entries, the actual whatevers, we want to be entering at demand levels, we want to be entering at supply levels. These demand and supply levels give us an indication of where the market could be going to. How is the market going to get there? That's where we involve our patterns and all of these extra things that we involved in, all the other tools that we've been taught. Now, obviously, guys, if we see a descending structure, descending from supply to demand, remember, we're in an uptrend. We want to be entering the market at demand. We know that the market is going to go to a level of supply. This pattern that we see that the market prints out gives us an indication of where the momentum is going to kick in. So we use supply and demand to determine areas of entry, areas of exit. We use these structures, the actual structures that the market prints out. Those structures we use to determine where the momentum is going to come in. Remember, we can trade from supply into demand in an uptrending market, but what would we need to understand? First of all, we need to understand the probabilities involved in us trading against the trend, and also we need to understand that it's going to take a lot longer for us to hit our targets trading against the trend from supply to demand. So these structures that form within supply and demand give us an idea of where the next momentum could shift to. Obviously, like our example, we said that we're in an uptrend, so prices are coming from the up, finding some demand, and then we know the next momentum will come to the upside. So guys, I hope that this video was actually enjoyable. I hope that you guys gained something. I don't want to stretch this video on for too long. I just want to go over the basics of supply and demand because we're going to expand on these ideas. Remember guys, this is a smart money concepts series, so every video within the series is going to first of all touch on ideas and notions from previous videos, and also we are building a foundation to expand on our knowledge. The whole purpose of this YouTube channel, the whole purpose of these videos, of the series, is for us to understand the market differently. We want to understand the market like smart money understands the market. We're using our retail tools of support and resistance, of chart patterns, of all these things to execute, to enter, to exit, all those nice good stuff, but we still want to have an understanding of smart money. What is smart money doing? How do we follow smart money and all of that nice extra juicy stuff that come along with it? So guys, we have reached the end of this video. Obviously, like I say, the comment section is yours, guys. If you want to go through any concepts, any new ideas, any whatevers, drop it down in the comment section. Let me see it. We'll engage. We'll go into those topics just for you. Otherwise, guys, we've reached the end of the video. Give this video a like if you have enjoyed the content, and if you think that it was valuable enough to you, if you gained something, then definitely give this video a like. This is T.Mayne, your FX Chaser's mentor. I'll see you guys in the next video.